So today we're going to talk about Silicon Valley Bank, or what I call all hat, no cattle. For those of you youngsters, what that means is that you have a cowboy hat, but you own nothing. And that's what I'm calling Silicon Valley Bank. So on this channel, we like to talk a lot about the difference between cash flow and capital gains. And I believe Silicon Bank was focused on capital gains and not cash flow, which is the issue that can happen to a bank, a business, or an individual. If you look at the origin of Silicon Valley Bank and what they primarily invested in, they were startups in the Silicon Valley area, and they were tech companies that had little to no cash flow in the beginning, but high valuations. So just like an individual, capital gain versus cash flow. Not a lot of cash flow in those businesses and relying on the market taking the value higher. So for this video, I'm going to show you graphically through accounting. So on the top here is an income statement. You have your income and your expenses. And the bottom here is your balance sheet, or your assets and your liabilities. So as you can see, a cash flow for assets, the bank would typically have an asset down in this category, which would produce income into the top category, and then they could pay their expenses and their liabilities. So the first red flag that happened with Silicon Valley Bank is that they went out to try to raise some short-term cash, which would typically be in the asset column, to cover some losses in the bonds as people were trying to withdraw their money out of the bank in the form of deposits. Now, for the bank, deposits are a liability because they're actually somebody else's money, so they're a liability to the bank, and therefore they're also an expense for the bank. So the Silicon Bank had liabilities paid out in the form of interest expense here, and obviously not enough income, so then they had to do a cash call. So they clearly didn't have the cash in the asset column to be able to cover those losses from the bonds when the people wanted their deposits back. Again, this is basic accounting. It can happen with a bank, a business, or a person. This is a classic example of not having enough cash flow based on the banking regulations to cover the liability. So let's take a look at this a little more closer. Over here on the left is Silicon Valley Bank, and over here is your basic customer. We'll just say these are all their customers. Okay, so most people have income primarily coming in the form of a job, or maybe a business, or maybe it's passive income. It could be whatever it is. In this case, they have $175 billion in deposits sitting in Silicon Valley Bank. So those deposits are now a liability of the bank because they owe these customers that interest on their money in the form of about 3%, which is about the savings rate right now. That equates to about $5.25 billion in interest expense, and that is an expense of the bank. What we don't know, of course, is what the assets are actually doing to cover the income side of Silicon Valley Bank. So the issue here is just a cash flow issue. That's why Silicon Valley Bank had to go out to the market and try to raise some money to cover those bond sales that resulted in a loss when people were trying to get their money out of the bank. So how could all of this been avoided? It all falls back to cash flow once again. So if you're a customer over here, let's don't pay attention to the bank, and you're actually buying houses, and as you buy more and more assets over here, whatever they might be, it contributes to the income, then the income pays your expenses, and the excess buys more assets, which provides you more income. This is the income in the balance sheet of a rich person, one that uses the income to buy assets to produce more income, pays their expenses, and continues to buy assets and continues to have more income as they continue to do this over and over and over. So this is why I continue to teach this stuff, guys, because this is happening to flippers and wholesalers right now. If you don't have the cash flow is king to cover these kind of short-term or long-term issues, then you're going to be out of business rather quickly, just like Silicon Valley Bank. Now, guys, this is a complicated issue, and the banks are typically invested in all kinds of things. But if you have cash and cash flow and cash reserves, you never get into these kinds of situations.